afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade with another episode of Tech Talk. We've got a handful of markets for you today: corn, soybeans, live cattle, and lean hogs. Before we get into the charts and analysis, we'll take a look at some of these closing prices today. We saw March corn trading in a 6.25 cent range, settling at $6.56. That was up 1 on the day. March soybeans 18-cent range, settling at $14.93, up 8 on the day. March wheat 17.75 cent range, settling at $7.40. That was up 9 on the day. Moving over to the livestock, we had April live cattle in a 77.5 cent range. That was down 32 on the day, settling at 161.32. March feeders down 95 on the day, closing at 185.55. That traded in a $1.80 range. And bringing up the rear, we had February lean hogs, which have been the laggard as of late. They were down another 50 cents today after trading in a $1.32 range, closing out at $79.30. So those are the closing prices. And we can get into the charts here in a second. But before we do that, I want to remind you, we do put out a lot of great commentary and content each and every single day. So if you have not signed up for a free trial of it, you can head to our website, bluelinefutures.com. There's a research tab here. Scroll down, sign up for a free trial, and you can pick and choose your markets that you would like to see. The Morning Express covering some of those outside markets like the S&P, crude oil, gold, etc. And then the grain and livestock, which I might be a little biased, but those are my favorite ones. And we've also got some currencies and soft reports as well. So again, if you haven't gotten set up for a free trial and would like to see some of the daily technical and fundamental commentary, head over to bluelinefutures.com and get yourself signed up. Now that we got that free little promo out of the way, we can get into the charts. The first chart that we've got pulled up here is March corn. There's really not a whole heck of a lot to talk about here other than the fact that we're just consolidating and I think building up for potentially a bigger directional move. Now, this USDA report tomorrow is typically one that is known to hold some surprises. I'm not so sure that we're going to get a big surprise. But even if we don't get any real new news, that might be enough for funds to say, hey, there's nothing new here. Why are we still net long? And you remember, funds have been net long for a long time, about 2.5 years now, and it used to be they'd cycle in and out, right? We'd see them step in the spring and summer and sell off in the fall and winter. But they've been holding a sizable net long position for quite some time now. So if there's not any new news to propel this market higher, I really wouldn't be surprised to see some long liquidation kick in and potentially take us below these recent lows here near 647. And then we head down to the December lows, which is closer to 635, 638. If you recall, we talked about this in our daily commentary. This was a gap back in August. And if that doesn't hold, it would imagine it could potentially snowball. Now, again, I don't know that it's going to play out that way, but that's my concern, especially for producers who haven't really locked anything in or still have some risk to the downside open. I think it's a good idea to consider looking at protecting some of that, and I think the same can be said with the soybean market as well. Soybeans, obviously a lot more constructive of a chart here as we've made a series of higher highs and higher lows, but we are starting to consolidate near this $15 level, which was a pivotal and a point and an inflection point really going back all the way to the summer months, right? This is where we broke down from in June, became resistance, got out above here, filled the gap that goes back to June as well, and now we're back here consolidating, waiting for that new news. I think the dry weather concerns in Argentina are certainly helping the market stay afloat. But again, as with corn, I'm a little bit skeptical and a little bit concerned of long liquidation, because if we cannot get back out above $15, I wouldn't be surprised to see funds lighten the load a little bit there. Now, I'm mentally prepared to be wrong. And with that in mind, I think options are a great way to play both these markets, especially if you're a producer in the corn and soybeans. Looking at the CME volatility indexes, we've got the CVol pulled up here, and these are at relatively low levels. As you can see here, this is the 1-year trading range for the CVol indexes for the agricultural markets. We're at the lower end of the range. Volatility is relatively cheap. So if you're a producer who wants to remain bullish but protect the downside, I think this is an excellent opportunity to shop for some options, which we've been doing with clients here over the last couple of weeks, really at the end of the year, into the new year. and setting ourselves up, I think, knock on wood, in a good position here to start 2023. So again, these indexes are low, which means volatility is relatively cheap. Protection is relatively affordable compared to what we've seen over the last year. Right now, the corn CVol index is at 2309. To give you a perspective, the 52-week high and low, 1682 on the low side, call it 67 on the upside. So we're definitely at the lower end of that, and I think that presents an opportunity. Now, moving over to the livestock, we've got April live cattle chart pulled up here. We made a run at those recent contract highs in yesterday's session, but really weren't able to get much follow through, and we kind of peeled off into the afternoon session and into the close, and some of that weakness seeped into today's session, but it wasn't an all-out breakdown, right? The chart still remains rather constructive, higher highs and higher lows at the upper end of the range, but I'm a little bit skeptical of this market as well. Not to say that we can't continue to go higher, I just don't know that we're going to be screaming higher, and so I think that we could potentially see this market pull back if the cash market really doesn't get going. I know that we've seen it firm here over the last couple of weeks, but it wasn't anything to really get the bulls excited or super excited. Right now, the fund's long about 85,000 contracts there, which is a pretty sizable position. So if the cash market does stall out again, as with soybeans and corn, I think there is risk of long liquidation. The line in the sand for the bulls to defend comes in near 160.5. This was the previous highs. Breakout point from December 21st and the lows over the last week and a half. Break and close below there. I wouldn't be surprised to see some of these major moving averages get tested. Again, a lot of that probably going to be pending on the cash market going forward. So I guess that's kind of what we're looking at there for live cattle. We've got lean hogs pulled up too. I was going to talk about the outside markets as well. Might as well touch on that while that crossed my mind. We do have a big day tomorrow in the outside market. CPI, or the Consumer Price Index, is the leading indicator for inflation. That's out at 7:30 a.m. Central Time. And that could potentially be another headwind for the cattle market if we continue to get slower growth. Potentially means that consumers will, clutch their pocketbooks a little bit tighter, and that could be a potential headwind there, and a catalyst for some long liquidation. But we expect to see that volatility at 7:30 tomorrow morning in the outside markets, in the currencies, and that could potentially spill into the agricultural sector tomorrow as well, including cattle. And we've got weekly export data as well tomorrow morning. But now we can get into lean hogs. The last and not least market, we went and filled that gap that we've been talking about. That gap came in from October 6th and got down near, I think it was 79.15 was the low end of that gap. And we filled it and rebounded a little bit, but really after such a precipitous fall, you would really want to see a bigger springboard off of that gap. I like buying and being bullish down against this gap, but the fact that we couldn't get that springboard reaction after such a steep sell-off is a little bit of a caution flag, and certainly keeps the door open for a retest of these October 4th lows, which comes in at 76.40. Potentially exports can give this market some direction out of the gate tomorrow. If we get some good exports, maybe we see a sharp recovery back towards this breakdown point near 82. Bad exports, you're looking at 76. So again, all eyes on tomorrow morning's data to see what this market wants to do as we head towards the end of the week. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Lion Futures. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors. Thanks a lot.